We'll wait a couple seconds for some people to get in here. It's good to see you again.
Yep, good to see you, Tyler. Thanks for
Uh,
having me.
yeah, and I know when we met up at the AVL investor real estate meetup, you had to wait a long time to chat. So, and I wanted to continue coming and getting pulled away and chat with you. So, I'm glad that we've gotten to know each other though, because you've been so helpful so far for our clients. So, it was really good timing, I feel like.
Yeah, absolutely. It was nice to meet you at that event, and since then we're helping each other. So yeah, it's been a good partnership so far.
Yeah, awesome. It's I think what one thing I was really excited about was like, there's so many cost seg people out there in the national realm for short-term rentals. But to have somebody local here that could help our actual clients boots on the ground, I think was pretty important. And we've already seen where that's been super helpful. I know some of our clients have already experienced that. So thank you for that.
Yeah, no problem. No problem. I've got a lot of clients that have short-term rentals in the North Carolina and even Tennessee mountains. And so, yeah, a lot of times they can't make it out here, so I will just drive to their property and do the site visit for them. So it's certainly convenient in a lot of ways.
Yeah, that's super helpful. Cool. Well, it looks like we've got some people on here now. So good to see all y'all in Facebook and YouTube land and everywhere else that this is being broadcast again for the second time today, even though I've not been live in a couple of weeks now. So it's great to see you guys so often today. And please, as always, go ahead and put any comments that you have in the chat below. As you guys know, I typically go into stuff like this without a big, huge agenda, and we love to kind of riff off of your feedback. So if you have questions about cost segregation studies and what that means or what that is, or any questions around it, please put it in the comments. We'll be happy to riff a little bit off of what you've got to say there. So, Jason, get us started. Tell us about yourself, and then what the heck is a cost segregation study? I mean, I know it saves a ton of money. I'm in the middle of doing one with you right now, but I still really, at the end of the day, have no idea what any of this crap means. So, and like break it down Barney style for us. What is a cost segregation study? Who are you, and who is Cost Seg Authority?
Yeah, sure, no problem. So I'm Jason Peterson, and I live in Asheville, as you probably know that already. Uh, I grew up in Winston-Salem, so not too far away from here, but now my family and I reside here in the beautiful mountains of Asheville. I have an accounting background, so I can remember doing depreciation problems back in the day by hand. But now I work for Cost Segregation Study, and we are we are a homegrown boutique cost segregation firm that started by a father and son CPA. They are headquartered outside of Salt Lake City, and they have been doing cost segregation for 17 years. And all of their knowledge, their information has developed into their software to handle cost segregation studies. And that's who I work for now. Let's see, what is a cost segregation study? Well, at the simplest terms, it is a way to accelerate depreciation on an investment property. So, as an investment property owner, your CPA is going to handle the depreciation on that property two different ways. The first is straight line depreciation, which is what the majority of people do because they're not aware of cost segregation. And the second is cost segregation, which accelerates depreciation by taking tax laws that reclassify items from a long term year. Short-term rentals are depreciated over 39 years. However, a cost seg study reclassifies some of those items out of the long-term category into a shorter term category, 5 year, 15 year, etc.
Got it. Okay. And why is that? Like, what's the reason for that? And why is this sunsetting? Why is this going away?
Well, cost segregation is not necessarily going away. So, cost segregation has been around a lot longer than I've been around. It goes all the way back into the Industrial Revolution when our settlers came here and had large industrial plants, manufacturing facilities, and the government had to come up with a way to depreciate that equipment. So when it was time to replace the equipment, there were tax benefits in doing that. So it's been around forever. However, there is something called bonus depreciation, which is, I believe, what you're referring to as sunsetting. And bonus depreciation is kind of cost segregation on steroids, I like to say. You know, all properties placed in service in late September to the end of 2022 qualify for 100% bonus depreciation. And that means all that reclassifying I was talking about, reclassifying assets into different lifespans, like flooring, for instance, appliances, things of that nature are depreciated over 5 years. The 15-year category, just think of it as land improvements, things on the outside of your property. And the bonus depreciation comes into those two categories. Whatever the benefit or the depreciation dollars that you find from a cost segregation study in those two categories qualify for bonus depreciation depending on when your property was placed in service. So it's going from 100% for all properties placed in service in 2023. It's now 80% that you get to take in that first tax year. The remaining 20% is spread out over 5 years in the 5-year category and 15 in the 15-year category. 2024, it goes to 60%, and so on. It's phasing out. However, it's the one thing that, regardless of what your views are politically, a lot of our folks in the government invest their money in real estate, and usually they make the laws favorable. And there is a chance that it could be put back. You know, I'm hearing that it could be put back into 100%. We'll just have to wait and see.
That would be great. So I know the one question that we're getting, you and I, especially over and over right now, is what is the latest time of year? And by the way, I just want to say I've been telling all of you to get your stupid cost segregation studies and your properties in for months now, months and months and months. And I told you, do not call me on November 1st for your cost seg properties. And yet my phone is blowing up. So I warned you all to do this beforehand. And so now you have to compete all over the same properties. Okay. So I'll just, that's my bone to pick with all my investors right now. But anyways, outside of that, what is the latest time in which you could put a property under contract if you were to close in 30 days? What is the deadline at the end of the year? And obviously we know that there's no hard deadline, a soft deadline based on your average recommendation. What would that look like? When is the latest somebody could close and then still fit in a cost segregation study on that property?
Yeah, it really all depends on when that property is placed in service. And, most properties are turnkey in many cases. So, that means your place in service date is going to be on your closing date in most cases. You close on your property, you immediately get your Airbnb site up or wherever you're posting, your short-term rental, and you're off and running. Um, it's a little bit of a gray area, but my founders have done hundreds of these studies, thousands actually, and really, as long as your property is placed in service before the end of the year, and by placed in service, the IRS substantiates that by, or you substantiate that by not necessarily having bookings, but that the property is ready for bookings and that is being advertised for bookings. So technically, you could close in December, even mid to late December. I did a cost seg study for a person last year, after they had closed in mid-December. It's all about when you have that property ready and available for rent, regardless of if you get a tenant or not.
Yeah. So if it's going to take about 4 weeks to close on an average property, we really only have a couple weeks left, right? So if we get to, let's say, mid-November, we're going to take 4 weeks to close, and that's mid-December. We've got about 3 weeks from right now to really get something under contract, right? Unless you're going to buy with cash and you can close in a couple of weeks. It's go time. It's time right now. And we're seeing that. We've put 14 properties under contract in the last 2 weeks, and almost every single one of them, the clients are going to do a cost segregation study. And I think it's worth it. I would never tell somebody to buy a property just to get the tax benefits. You should still buy a cash flowing property. But everybody knows that works with us at Savvy that we won't sell something that's not going to cash flow anyways. So that's besides the point. I think really what I really like the most about what's happening, you and I ran some preliminary numbers on a property that I bought in February and launched in June. And I put 10% down for that property. It's an $850,000 property. So I put about $85,000 down. And you and I have already looked at potentially being able to pay more than $85,000 less in taxes next year by doing the cost segregation study on that property. So in essence, here's the story on this property, right? So with the net that we're estimating now for year one, which we have tons on the books already, even up until next summer. So I think it's a very reliable number. Our net should be a 50% cash on cash return. And so if the other 50% that we put into the property was down payment, because it was about the same. We put about 80 into furniture, about 85 into down payment, right? So I will effectively net out at 100% cash on cash return in year one with the Cost Seg study, right? I get every penny back that I put into the property in year one. And after that, every dollar of cash flow is infinity cash on cash return.
Absolutely.
What do you see as the normal amount? Is there some sort of a calculation that you can do on what a normal for short-term rental properties, which is kind of what we're focused on? What do you think is the normal amount?
I mean, there's so many different variables that go into it, and each property is unique, right? I spoke about the 15-year category of land improvements. So, some properties, especially here where we are, the lot might be just natural forest, and that's great. Another lot may have, a lot of concrete driveway, a garage, a beautiful slate stone outside area with a gazebo that has power to it. And all of these types of land improvements and things. So, I usually recommend one, just find a property that you're happy with and happy with the price, and the cost seg takes care of it itself. But, land improvements, there's things that will add to how much you can put there, depending on what the lot looks like. And then on the interior, finishings. Is it high-end cabinetry and countertops, versus just some old pine cabinets, et cetera. Some of the finishings and things like that can also determine, how many dollars you're going to be able to reclassify that into.
Mm-hmm.
But how much of the basis you get in return back, and by basis, I use these terms all the time. I realize some people might not know what I'm talking about, but your basis is basically your purchase price minus the land value.
Got it.
And that's what's depreciated. But the return on that, I think the industry standard on a cost seg is between 18 to 22% in that bonus category. And we find that we get closer to 25 to 30%. But each property is just so unique that it's really hard to tell.
Yeah, got it. Okay. So we have a question here. Facebook user said, can you talk about how material participation comes into play with the cost segregation? So what even is material participation? For those that don't know, what is it and how does it come into play?
Yeah, sure. Absolutely. This has come up recently with a couple of clients. So, so there's an advantage to setting up a property as a short-term rental. Tyler, who's a real estate professional, he lives and breathes real estate all day, every day. So he gets to use the benefit of cost segregation to offset his direct income, without any questions asked. He qualifies as a real estate professional. However, we have lots of clients that, do this on the side. It's their side hustle. And, maybe they have a spouse who has a completely other job, and they have time to, help out and do other things. So there is material participation comes into short-term rentals. So if you manage your short-term rental yourself, then you may qualify for material participation, which means that you didn't hire a property management firm. You're the one collecting rent, setting up the cleaning service, anything. You're managing that property. You may qualify for material participation, which means that you now get to use that income or the depreciation from Cost Seg to offset your direct income as well. So it's a way to not be a real estate professional, but still utilize the Cost Seg benefit on your direct income.
Got it. Okay, so we have another question. Facebook user also said, if we have previously just used standard deductions for our properties, can you still do a cost seg?
And the answer is yes. This is, a lot of people don't know that you can. They think that they've missed the boat if they've been using straight line depreciation on their property. But you can actually get what's called catch up depreciation. And you do not need to go and amend tax returns or anything of that nature. The IRS actually allows you to switch a property from straight line depreciation to a cost seg model. And there's a tax form called a 3115, which we actually prepare for you and for your CPA when we provide you with your final study. So a lot of times I'll work with a client on a new property. They know they can do cost seg. And through those conversations, I learn about, this expansive real estate portfolio of properties that have been placed in service many years ago. And I run the analysis for them, and the ones that make sense, that there's still a very good benefit, we switch those over. And the ones that don't make sense, maybe they've been depreciating for years and years and years, then obviously we leave those alone. So the short answer is yes, you can, and we can help you do that.
I think for me, one of the things that once investors really understand how much money they can save in taxes, they start to really see the value of a cost segregation. For those that don't or don't even know anything about it yet, from a short-term rental perspective, what's the most you've ever seen someone be able to not pay in taxes from buying one short-term rental property? Just so they realize the impact of this. I think that's kind of what I'm trying to get across.
Yeah, I mean, I think some of the larger, more expensive properties, I've been able to offset their direct income in the hundreds of thousands of dollars. So, probably around that $200,000, $250,000 range. Obviously, those were, the more, not to go back to my accounting, but the larger the basis, meaning the more expensive the property, the more dollars there are to play with. So, yeah.
And what comes into play there as well, from what I understand, is if the land, because when you're talking basis, you mentioned that it's the value of the real property minus the land, right, is your basis. And so if
Correct.
everything is based on the basis, then purchasing in a place where land has a lower value brings you more value on the cost seg.
Yes, it does. The land here in the North Carolina mountains and surrounding area, some may say it's really expensive. However, all I would need to do is show you some of the cost segs that I've done for short-term rentals on the coast of California, and you'll quickly realize that land value is still pretty reasonable compared to the rest of the country. So, out in California, the land value can be worth more than the actual structure. And that just hasn't impacted, the area here.
Yeah, that makes sense. So we have a question here. How would an investor who does hire a property manager use a cost seg to offset capital gains on sales of other properties, or is that not possible?
Yes. So we talked about material participation, which is a method to offset one's direct income. However, there are many other benefits of cost segregation. If you do hire a property management company to manage your property, you're able to use the depreciation dollars to offset passive income streams. And that could be, K1s from other businesses, dividends. It could be you have a real estate portfolio of multiple properties and you're still getting taxed on the rental income after all of your other write-offs. You're still able to use whatever amount of those depreciation dollars from cost seg to offset the rest of that rental income and bring it to zero. And the beauty of cost segregation is, you know, let's say you find $200,000 in depreciation that you're able to utilize for a tax year. You do not have to use all of it in that tax year. So you're able to use what you need by, working with your CPA, and whatever is left over rolls over to subsequent years. Another benefit, you mentioned capital gains. So I've lowered, when you sell a property, hopefully, you made a good investment and you're going to make a profit. Well, you're going to have to pay a capital gains tax. And cost segregation can actually lower your capital gains tax in a couple of ways. One, let's say you hold on to your property. Let's say you hold on to it for 5 years. You get a great offer, life happens, you need to sell that property. Well, we talked about the 5 year category being your flooring, shelves, cabinets, all of those types of things that the IRS allows. Well, after 5 years, if you've utilized a cost segregation study and have your 5 year assets on that depreciation schedule, after 5 years, they're worth $0. So now you're able to lower your capital gains tax because you've depreciated off thousands of dollars on the 5 year category.
Wow.
Another way is, some people will sell a property, um, cost seg it, and then they're able to use those depreciation dollars to offset they'll acquire a property, cost seg it, and then use those depreciation dollars off the new property to offset the capital gains tax of the sale of another property. So you can kind of sometimes share the dollars in your portfolio, so to
Wow.
speak. Now, there are some laws that are different, that vary state by state. But that's why, we like to partner with your CPA and make sure that, all those things are covered. But
That's
yes,
incredible.
yeah.
So what I'm hearing, and just because I'm not a tax guy, I'm not a numbers guy. In fact, I typically don't really get along with most accountants because I'm the guy that I don't even keep the receipts in the shoebox. I just don't keep the receipts at all. I don't even know what I spent last week or what I spent it on. But to me, what I'm hearing, and so just correct me if I'm wrong, is that there's actually unrealized tax advantages well into the future outside of just the initial deductions that you get from a cost segregation study. When you go to sell the property later on, if you've eaten into that 5 or 15 year mark, that it will lower your capital gains on the sale of that property. And so what most investors are doing right now is doing a 1031 exchange, and that would lower the amount that they would have to 1031, right? And they'd actually get to keep more of that profit that they made from that sale. Does that all add, is that all correct?
Yeah. So, a lot of clients will acquire new properties by using 1031s. Now, you're not allowed to double dip. So, your CPA, let's say you sold a property, use those proceeds to acquire another property. Um, you know, what the 1031 exchange does is it lowers your basis because there's significant tax benefits in the 1031 exchange. But, I have found with the clients that I've worked with that most use the 1031 exchange as part of the purchase and not the entire amount. For instance, I have a client that's closing on an apartment complex in the next 4 weeks. He sold one of his properties from his portfolio. He's 1031 exchanging A significant amount of that money to acquire that property, probably about 30%. And then that's going to lower his basis. But then you cost seg on everything that's left. Hopefully I answered your question there.
Yeah. Yeah, well, I think it's all helpful, and really, this is the reason why you don't do a cost segregation study on your own, right? And you use an expert because I mean, this is like deep into tax code, right? I mean, there's gray areas, there's things that you've done, but we're not talking about a new short-term rental cost seg company. You guys have been around for decades. And if you look at your website, there's like hundreds of employees. And so obviously that means you guys have done thousands of these cost segregation studies and can stand behind those pretty well, or you probably wouldn't be in business. So definitely talk to an expert. We've actually got a link below for Jason's services. And his company. And in fact, actually already, the founders of the company have gotten on the phone with one of my clients to talk through some real complicated, cost segregation matters. And for me, that was really important because it just shows they care. And I know that's really hard to find at another company. And so I'm really loving working with you guys so far. What's the minimum home value? We've only got a couple minutes left, so I'll try to squeeze in a couple of these questions. What's the minimum home value threshold where you see a cost seg making sense to pursue?
Yeah, I would say, really, if you're working with a basis that's kind of over $100,000, and by that, I mean, a $200,000 purchase, land value is, close to 100,000, your basis is 100,000. That 100 to 150,000 range is kind of worth it in sometimes, at least to run the benefit analysis. But it also depends on the client, right? It depends on if you have real estate professional status, what exactly you're trying to offset, what your goals of the cost seg study are, because everyone's financial situation is different and unique. But, we'll run a free analysis for you and certainly guide you. And when it makes sense, it's very clear. And when it doesn't, we say, hey, this one doesn't make sense. We give that advice for free.
Yeah. Got it. Amazing. All right, guys, I have to run. I have another call, but Jason will actually be able to go into the comments of this video and answer any other questions. So if you have those, send them there. If you guys want to talk more about actually having a cost segregation study done, go to the link that we've posted in the comments. I think Grace posted that. It's costsegaauthority.com/savvy-realty-services. Jason can help you out from there. And if you guys need to get in contact directly with him, you can DM me, send me an email, shoot me a text message, whatever. We'll get you guys in contact. But thanks everybody for tuning in. Jason, thank you for coming and hanging out with us a little bit today. I really appreciate it. And I think we should probably do a couple more of these through the next couple of weeks because there's so many more things we could dive into, I think, right?
Yeah, there's a lot of different things, certainly.
Yeah, cool. Awesome. Well, thanks for taking the time, guys.
Yep. Thanks, Tyler. Thanks for having me.